It is Monday, December 2nd, 2019. It is 8 p.m. Pacific Standard Time, and so you know what time it is. It's time for a little bit of coin metal. And it was a very early get your ass kicked at Jiu-Jitsu Monday. We were doing some stuff from the saddle. And for those of you who are unfamiliar with the saddle, it's an interesting position you can get in by, you start off from a butterfly, and then you move one of your feet to the outside, roll back like you're going to sweep your opponent, but what you do is you lock down one of their legs by taking, say your right leg over their left leg and kind of triangling it underneath, and and I don't even know that I've explained that 100% fully. I don't know, that sounds about right. Anyway, it's an interesting position, and we've been working it in on the Monday classes just a little bit, and I enjoy it because I think that I've got the entry right on it. I've gotten the entry right on it a couple of times. And enough times to give me the impression I have the basic concept down, but I'm certainly not an expert at it. But nonetheless, I've been making a little bit of progress with regard to it, and although I keep losing one of the legs, like you got to reach through to their legs to initiate the roll, and we figured out that if you retain possession of the foot, it gives you a better setup for the heel hook. And I don't know, I like it. I like it a lot. Whether or not it'll be like a mainstay in my repertoire, I couldn't tell you. But it's an interesting setup, and it seems like if I were to master that hold on my opponent, that there's just a lot of potential. There's a lot of different ways you can go with it. I mean, it seems to me that if I were to go the right way, that I could work that around to a back take opportunity. So, like I said, it's an interesting setup, and I'm sure there's videos all over YouTube. So I'm not giving away anything hyper secret or anything like that. I'm just not being incredibly detailed about how much we covered today, because we did cover quite a bit, but all from that position. And like I said, it seems like a setup with a lot of potential, and I think if I were to get it like if I were to get everything that we did today 100% correct, that it could be a significant tool in my leg game, because I really don't have one of those. I'm just trying. It's not really a focus, or at least it hasn't been much of a focus on in my jiu-jitsu to date. So it's part of the school that I'm in. There's a lot of liability issues that come up with teaching people the leg game, and so when you're giving it to people that aren't necessarily prepared for it, I don't know that I see 100% merit in that, because the thing that drew me to the leg game at all was this comment, and I can't remember who it was specifically who said it, but it was the thing that got John Danaher into working that leg game and developing his leg game system. And that's that, why would you ignore 50% of the body? It makes too much sense. There's too many submission opportunities there to ignore it, And so anyway, that drives me to it as well. It's like, I don't want to get in a situation where I'm against somebody who has a very, very well-developed leg game, and I've got nothing, and I'm not used to training it, and invariably they tweak my ankle or they tweak my knee, and it's 4 to 6 months out for me. Fuck that. So yeah, like I said, it's better to equip oneself. So I've been welcoming the additional concentration on the footy stuff. Like I said, I'm not saying that I've got a developed game, because I don't, but I'm getting more than I had, and I think that's the important part. Anyway, let's go ahead and throw down with some music. And our first dance is going to be Body Count. It's got to be. It's destiny. But as far as which song, though, that's the question. It always is. And so, let's see here. Let's go with something off of Bloodlust. Or, wait a minute. You know what? I haven't played this one in a long time. Here it is. Institutionalized 2014, First Dance. Here on Coin Metal. And that was Killing Joke with Loose Cannon. Yeah. So as far as what we're going to get into today, got a whole bunch of tabs open as normal, because you got to be prepared. And this first one here is on Zero Hedge. And I kind of want to start off on the fiat side of things. And here it is. America's giant debt for equity swap exposed. And this is by Tyler Durden. Oh, wait a minute. You know what? Let's go to the original source if at all possible. Because that's what we do here. Yeah. No. And this is on AIER.org. The Giant Debt for Equity Swap. And this is by Colin Lloyd. And it was authored December 2nd, 2019. So yes, penis. Since the mid-1990s, the number of companies listed on U.S. stock exchanges has been steadily shrinking. There are currently just over 4,000 companies listed, up from the 2012 low, but way down from a peak of more than 8,000 in 1996. Europe has not been immune. Only 84 companies have listed this year, the lowest in a decade and the lowest by deal value since 2013. European capital markets have always been less equity-centric than the U.S., but even here the number of listings has shrunk by 29% since 2000. Ooh. Weird graph looking there. In the post-financial crisis period, three factors have driven the retreat of listed equity. The rise of private equity, an industry that is estimated to be sitting on more than $2 trillion in capital, awaiting new opportunities. The slower pace of new companies launching on public markets, due to the availability of private venture capital, and mergers of existing listed companies. Behind these factors lies a more powerful force, artificially low interest rates. In a low interest rate environment, the appeal of debt financing increases relative to equity. This seemingly benign influence has profound implications for capital markets and the economy more broadly. By means of debt finance, earnings per share can be enhanced without the need for productivity gains. For the executives who direct those companies, the incentive to borrow externally rather than improve internally increases as debt financing costs decline. Conversely, in a rising interest rate environment, these same executives are incentivized to improve the internal efficiency of their enterprises. To this extent, higher financing costs can contribute to improved productivity. Financing costs have generally been falling since the 1980s. During this same time period, executive compensation, especially via the award of stock options, has risen dramatically. Owning call options gives an investor a different incentive from a stockholder. The option holder's preference is for capital over income. High dividends directly reduce capital value. Executive holders of stock options favor lower dividend payouts and higher earnings per share. Falling interest rates have also impacted some income-seeking investors. Faced with declining returns from fixed and floating rate investments, these investors have been forced to accept higher risk in the form of increased duration, greater credit risk, or leverage. Duration risk is unique to fixed income investment. All other things equal, the longer the maturity of a fixed rate bond, the longer the duration, and therefore the more sensitive the price to a given change in the yield to maturity. As short-term interest rates have approached zero, the normally upward sloping yield curve has flattened. In developing markets, this has been exacerbated by the central bank policy of quantitative easing. By this process, some investors are forced to look elsewhere for returns. If the return from extending the duration of your portfolio has diminished, an alternative source of yield can be found by the purchase of less creditworthy debt. The insatiable investor's thirst for yield has been quenched, at least in part, by private equity, venture capital, and leveraged buyout funds that have securitized their borrowings. Demand has also been met by a wide variety of corporate borrowers, many of whom issue debt simply to fund share buybacks. This debt may take the form of fixed or floating rate bonds or loans. For a small group of income investors, the alternative to fixed coupons or floating rate notes is the outright purchase of equity. In relative terms, this alternative has disappointed. Income stocks have generally underperformed growth stocks during the last few years, in part because capital appreciation pushes stock prices higher, which attracts momentum investors. A stronger influence, however, is lower interest rates, which make higher price/earnings multiples more manageable. In addition, low rates encourage expectations of lower returns. They also make investors more fee-conscious, favoring index tracking products over discretionary funds. Where are we now? To recap, the breadth of the listed stock market is in long-term decline. Debt finance is cheaper than equity finance. For corporate executives, share buybacks are preferable to capital investment. Corporate debt levels are at or near all-time highs. The credit quality of the outstanding debt is deteriorating. Further cause for concern is the changing makeup of debt. While corporate bond issuance has been growing, the corporate loan market has been in the vanguard of the expansion. The chart below shows the changing relationship between bonds and loans. The level of debt relative to GDP may be at new highs, but the cost of servicing the debt interest is relatively low due to historically low official interest rates. The real risk in a recession is that credit spreads widen even as official rates are eased. As growth slows, U.S. Treasury bonds may reach new highs, but lower-rated bonds and loans will still be sold. The credit intermediation process relies on banks continuing to lend, but banks are notoriously procyclic, pulling their horns just when they are needed the most. Pulling in their horns just when they're needed in the most. The current environment is not entirely negative. Oh, Jesus. Sorry. Robust corporate profits during the long, slow recovery mean that debt is, as a share of the total firm financing mix, is much lower today, 25%, than it was during the 1980s and during the 1990s, 50%. The debt mix has tilted, however, toward floating rate loans rather than fixed coupon bonds. The weakest link for financial markets today may be found among leveraged loans and their investors. The principal buyers of leveraged loans are banks and insurance companies. The table below shows the current mix. Let's see, European banks, UK banks, Japanese banks, US and global banks. As the table reveals, many of the higher risk tranches of the loans are purchased by open-ended mutual funds or ETFs, but a substantial portion, especially those with lower risk, are held in collateralized loan obligations, CLOs. CLOs are generally floating rate tradable securities backed by a pool of, usually first lien loans, of corporations. Often these loans have poor credit ratings, many emanating from private equity, venture capital, and leveraged buyout transactions. On their own, these leveraged loans may rank below investment grade, but by bundling them together with better quality loans, CLO managers contrive to turn the base metal into gold. If this sounds remarkably like the collateralized debt obligations (CDOs) that harbored covenant light subprime, they loaded this one, that harbored covenant light subprime mortgages, which precipitated the financial crisis of 2008, then you would not be too far off the mark. CLOs do not contain mortgages or credit default swaps, but they do rely on the assumption that a diversified pool of loans has an inherently lower credit risk than the loan of an individual corporation with the same credit rating. Issuers argue that unlike the individual liar loans at the heart of the subprime mortgage debacle, CLOs contain loans of corporations that have been audited, and these corporations are from a wide range of industries. Suffice it to say, auditors can be deceived, and recessions sink all ships. CLOs are also a challenge for investors to value. CLO managers actively adjust their portfolios, and the risk profile is in a constant state of flux. These are opaque investments that are hard to evaluate and difficult to liquidate. It is not all gloom. Despite rating downgrades, CLO defaults are at a 7-year low of 3.42%. Investors may not be able to get out, but they should get paid. Or perhaps not. According to an October article in The American Banker, the loans of more than 50 companies have seen their prices decline by more than 10%. Moody's, the rating agency, admits that more than 40% of loans are rated B3 or below. I wonder how many degrees into the minus B3 is. While CLOs, by some estimates, hold more than half of all loans, most are not mandated to hold more than 7.5% of CCC-rated paper, since CCC is below investment grade. Why would it even be available if it was below investment grade? I've got to wonder. In a recent post from the Bank of England, How large is the leveraged loan market? The authors estimate that there are more than $2.2 trillion of leveraged loans outstanding worldwide, of which $1.8 trillion are denominated in US dollars. The chart below, the left-hand side, the speed at which the market has grown, and right-hand side, the increasing leverage of the overall market together with the alarming rise in covenant-light issuance. Oh man, it spiked quite a bit between 2012 and 2018. It is some comfort to know that central banks and financial regulators are cognizant of the potential systemic risk. They may yet contrive to avert a crisis. Covenant-light loans, however, remain a near and present danger. They constitute 80% of issuance, and by some estimates, as much as 29% of investment-grade loans are at risk of downgrade to CCC. If those downgrades come to pass, CLO managers will be forced to liquidate in concert. The natural buyers of less creditworthy leveraged loans have been notably absent of late. Leveraged loan mutual funds and ETFs have seen redemptions for most of the past year. Issuers and banks are mostly full up, and the underwriting banks have been saddled with a large portion of recent issues that failed to find buyers. Hedge funds are not stepping in to fill the void. Instead, they are short-selling high-yield bond ETFs. Short exposure is down from the highs seen in Q1 of 2019, which followed the high-yield rout of Q4 2018, when 25% of high-yield ETFs were liquidated. But around 40% of the market is now out on loan. The chart below highlights the recent change in appetite. Let's see. Nearly 40% of available U.S. junk bond ETFs are on loan. The size of the high-yield bond ETF market is small. Estimates range from $34 to $60 billion. And the cost of borrowing stock to fund short exposure is relatively high. But there is more than $500 billion of high-yield bond mutual funds that could follow. The liquidity mismatch between the exchange-traded ETFs and mutual funds on the one hand, and the underlying securities on the other, should not be underestimated. The total outstanding issuance of high-yield bonds is around $1.2 trillion, added to which the risk of contagion spreading to loans and CLOs cannot be ruled out. Back in the loan market, it seems the rating agencies are finally beginning to confront reality. S&P recently announced that the number of loan issuers rated B- or lower, referred to as, quote, the weakest links, rose from 243 in August to 263 in September. Notwithstanding the significant increase in the number of issuers, this is still the highest figure recorded since 2009. The Federal Reserve has been proactive, cutting rates even as unemployment data made fresh lows. In the near term, some headline measures of inflation have increased, but the amount of debt is so vast as to be almost self-righting. Any hint that the Fed may raise rates to head off inflation will see stocks fall and credit spreads widen. The effect of these market moves on expectations for economic growth will be negative. Commodity prices will decline, inflation will stall, and provided the Fed moves swiftly enough, a full-blown credit crisis may be averted. Nevertheless, as rates approach the zero bound, the central bank has progressively less room for maneuver. At the risk of repetition, in the longer term, the deleterious effect of artificially low interest rates discourages capital expenditure in favor of debt issuance and fund stock buybacks. It undermines productivity and reduces the long-run rate of economic growth. The number of stock market listings will continue to decline, while the sustainable level of price-to-earnings ratios will rise due to the diminishing supply. With interest rates near zero, stock will be supported. There are few viable investment alternatives in public markets. Income inequality will rise in tandem with the stock market, as, let's see here. Shit, I kind of lost there. No, got that. Central bank. Got that. Number of stock market listings will decline. Interest rates near zero. Stocks will be supported. There are few viable investment alternatives in public markets. Income inequality will rise in tandem with stock markets, as will the ratio of debt to equity. If governments choose to adopt a fiscal rather than a monetary solution to the lack of economic growth, and I am not advocating negative interest rates, they will pile even more debt onto an already over-encumbered marketplace. Due to the demographic headwinds facing most developed countries, consumption demand is likely to remain lackluster for the foreseeable future. Inflation and interest rates are unlikely to rise in this scenario, while corporate earnings growth will be forced to rely on financial alchemy rather than sustainable productivity. Artificially low interest rates are hollowing out the productive capacity of the economy. The price of stocks and bonds may remain exalted, but this is not a sign of economic health. And that was by Mr. Colin Lloyd. Yeah, I think he's onto something, and although I noticed that he doesn't talk at all about any of the other factors in the market that could be affecting the lack of growth. And I would posit the possibility of overregulation on the market at both the city, or not both, at the city, county, and state levels, as well as federal. I think the regulatory morass that people are faced with these days in just starting up a business, I mean, much less a finance-related business, is just so high that most people give up before they even launch. You know, I tried to launch a small company, and I found out that I was having to pay sales tax on products that I myself manufactured. I bought the materials to make the products. I paid sales tax on those, or some sort of excise tax in the process. I made something with those materials, and then I turned around and tried to sell them. And because I did sell some, I had to pay sales tax on products that I manufactured and I sold to someone else. No. Fuck you. You don't deserve any fucking taxes on shit that I made with my own hands. Who the fuck are you? So yeah, and no, not gonna do that. I don't understand where these people come from. That they're like, oh yeah, we got to get a cut of every single transaction so we can fund this thing over here. And it's like, you wonder where money comes from to fund things that you couldn't imagine people wanting to fund. Things like ISIS and Al Qaeda. Those organizations get their money from somewhere. And it's not just doing deeds for people and doing nice deeds for people or whatever. It's because they're getting funding from national governments and private banks. Period. I don't know how many proxies they've got to go through to get it to happen, but that's where that fucking money comes from. And I mean, that's only possible when you have wholly unaccountable sources of funding, i.e. sales taxes, property taxes. Now, I'm not saying those specifically, but those are more or less wholly unaccountable lumps of money that the state and federal government accrues for whatever purposes, whatever announced purposes, but whether or not the funds actually are dedicated to the tag that they're gathered under is not in your control. It's in control of the people that are running the department. But yeah, so I think that overtaxation and overregulation plays a much bigger part in this economic downturn that we're observing. You know, in my opinion, we should have transitioned to the era of personal flight at least a decade ago. But you know, here we are, and our city and state planners and federal planners, you know, they're talking about pushing us all onto mass transit. What? I mean, could you imagine that? It's like, you know, we're on the verge of light speed in space, and we're on the verge of teleportation, but no, you've got to ride the fucking bus because you know we just can't be troubled. You know, the U.S. military can 3D print a fucking submarine to use for military purposes, but you know we can't 3D print a fucking air car for you to fly around in. You know, we can have all kinds of RC-controlled stupid pieces of plastic that fly, but no, you can't fly. You have to take the fucking bus. Can you see how completely ludicrous this is? You know, you're in an age where there isn't anything that you do in an office that you cannot do from the comfort of your home in real time. But no, rather than letting you do it from home, we're going to make you drive 15 to 50 miles to and from work 5 days a fucking week. Why? Because, well, it's fun. It's fun to put you in fucking traffic and make you have a fucking heart attack due to all the stress of sitting in bumper to bumper traffic for 2 hours. You know, you need to be subjected to that because, well, you know, it's fun. It's not because it's fucking necessary. I mean, really, take a good look at that cell phone that you carry around all day and think about it. How much of what you do in your office every fucking day could you do from that cell phone? Probably everything. You could probably do it through fucking FaceTime communications or fucking Skype or something else like that. But no, we have to live in the 18th century when you have to be to work by 9 o'clock and then you get to leave at 5 o'clock. Because, well, you know, that's just the way we thought to do it. Fucking ridiculous. Anyway, let's go ahead and throw back down into some music, because that was a terribly, terribly, terribly long analysis of what we kind of already knew, but it's good to get this stuff from multiple angles. And I've been wanting to play something off of Fear Factory Genexus. And so, let's go with... I haven't listened to all of this album, like, enough to associate the songs with their titles yet, so I'm just throwing it out there. And I think Battle for Utopia. Yeah. That's proper. Here it is, Battle for Utopia by Fear Factory, here on Coin Metal. And that was Voivod with I Conspiracy. Sorry about that, I let that run one over, but it was a good song, so I mean, you know, I can't be held fully at fault here. Anyway, so yeah, let's make a little bit of a transition over to the crypto side of things, and a little bit of in the form of a little bit of a kind of a synthesis between the two. And so here it is. This one's on blockchaintd.com. I don't think I've ever read an article off of these guys before. So here it is. This is by Diana, and that's kind of weird because Diana has a what looks like a schooner captain as her icon. So I'm just going to go with no penis because that's what the name says. And this is authored December 2nd, 2019 at 14:15, I suppose UTC. HSBC moved $20 billion from paper to blockchain. One of the largest banks in the world, HSBC, is planning to transfer $20 billion worth of assets to a new blockchain-based custody platform. It is an enormous improvement of the former system, as the bank is going to digitize paper-based records of private placements. Private placements are typically held on paper and need standardization, which not only makes accessing them troublesome and inefficient, but also influences toward an archaic and out-of-date system. The new platform of HSBC, known as Digital Vault, is going to provide investors with real-time access to records of securities bought on private markets, as an application of blockchain technology reduces the time it takes investors to make checks or other activities. Presently, HSBC looks after about $50 billion worth of assets, so it is taking a big leap of faith by putting 40% of this onto the blockchain platform. Not only is this a massive upgrade for private placements, but it is also a necessary one in an avenue that is expected to grow and be more attractive to investors steadily. Demand for private placements of both debt and equity has grown significantly in recent years. Investors are on the hunt for higher returns amid low interest rates worldwide. HSBC expects the global value of private placements to hit $7.7 trillion by 2022, a jump of over 60% from 5 years earlier. Over the same period, it thinks allocations by asset manager clients will grow to 20%, up from 9%. HSBC's decision to put $20 billion worth of assets onto blockchain technology is being announced as one of the largest deployments to the transparent and instantly available technology. According to an independent consultant who tracks the industry, Winsor Holden, the success is not going to be visible immediately. Actually, I don't believe the quote-unquote success will ever finally appear. See, the problem isn't the medium that the records are being held in. The problem is the nature of the the custodian, i.e. HSBC. They've had a lot of problems over the years. And this is not to say everything that they invest in or all of their branches are fraudulent, but they are continuously being caught in frauds and scams that span years and years and years. And mind you, this is a very highly regulated entity. It's an international entity. So it's not just regulated in one jurisdiction. It's probably internationally regulated and regulated on the national levels in all the jurisdictions that they operate within. So, it's like these guys, they're not new to business. They know what fraudulent activity is, and they know what non-fraudulent activity is. And of course, they're going to try to go down every single avenue possible to reap yield for their investors. However, it is the type of investments that they are willing to make that matter. And I think this is a point that it's only been the people that are really, really rich, that HSBC's holding on to their money, this $50 billion. That's not mom and pop retirement funds. That's, executive private equity funds and shit like that. But the point being that the benefits of moving this money around like this, it's not going to be felt by the average person. The average person isn't going to be intersecting with this. And so it's one of those places where, if you take every single person at HSBC and you make them all equal, including executives all the way down to the mailroom operators and fucking secretaries and stuff, if you make them all equivalent, now what does that do to them? You know, on the Bitcoin network, the Bitcoin network doesn't give a fuck if you're a CEO or the mail clerk. It doesn't care. Is the transaction valid? That's what it cares about. That's it. So if you take away all the pretense of some sort of advantage or privilege, when you take all of that away, you also lower the premiums for participation. But when you take all of it away, the appeal for private equity markets goes down, because we're not necessarily subject to what's going on in these markets. We can separate our monetary value entirely out of them into markets that only seem to appreciate against fiat and conventional markets. So HSBC can move all of the bullshit they want on their butt token network, their private butt token network. They can do that all they want. It's not really going to benefit the average person. And so we're not going to be seeing a progression of more investors. You know, people that are already involved in crypto and whatnot. I don't see them necessarily migrating over to HSBC because of this development. You know, and so all of the investment and whatnot, it might make it a little more frictionless for them and their clients, and that's cool and all. But the average person, again, isn't going to be partaking of those benefits. And so, you know, what's in it for them? I don't think really anything. Especially not when they can be participating in markets that are hardly impacted by these events. And like I said, they only seem to benefit from ill events that happen within legacy markets, with legacy participants such as HSBC. So, you know, why am I going to, if I'm going to make the leap of jumping into cryptocurrencies, why am I going to use some entity like HSBC to do it for me? I'm not going to, especially if I don't have to. Anyway, speaking of, you know, we're talking about putting all of this monetary value on a blockchain. Now, see, the problem with doing that is this. A private blockchain makes it a target of everybody not participating in it. See, because we don't suffer if we crash HSBC's fucking bullshit butt token network. If we manage to 51% their network, there's not a whole lot they can do about it. You know, and it doesn't impact us at all. So when you consider that, and you consider the possibility that there is an adversarial actor out there who knows these systems better than anybody over at HSBC or any of their proxies does, you know, what happens when they tie up a single transaction with, $2 billion in one transaction or something like that, and somebody targets that shit and gets it? What happens then? Is the equivalent of the FDIC going to come out and bail them out again? Is that what's going to happen? I don't think so. They're experimenting probably with customers' funds, and they're not going to be held liable because it's going to be all based on open source software. You might even see some sort of regulation on that end. But again, I don't see that as being all that effective in the longer term. You know, these dangers, if you look at the Satoshi paper and all of the talk that went around Bitcoin at the beginning, all of this shit was contemplated. You know, and we've actually read on this show a study concerning people trying to crack the private keys for existing wallets that are out there. And oddly enough, they seem to have a higher success rate busting SegWit and multi-sig addresses over legacy addresses, which is kind of funny to me. But anyway, it's with that in mind. I got this next article here. It's on cryptomute.com. Coinbase and a few exchanges, 1.9 million Bitcoin in wallets, a disaster waiting to happen. This is authored December 2nd, 2019 by Simon Nyenja. My apologies if I mispronounced that, but yes, penis. Major Bitcoin exchanges are reportedly holding more than 1.9 million Bitcoin in wallets. Coinbase, which is leading the pack, is holding 966,230 Bitcoin in its cold wallet. The leading American cryptocurrency exchange could be a disaster waiting to happen. In fact, since the 1.9 million Bitcoin is held by a small number of exchanges, BitMEX 265,140 Bitcoin, Bitfinex 146,120 Bitcoin, Kraken 136,780 Bitcoin, and Bittrex 131,140 Bitcoin, Coincheck 35,090 Bitcoin, Bitstamp and Poloniex, they're all potential disasters waiting to happen. Crypto exchange hacks are common. This started when cryptocurrencies became mainstream and prices skyrocketed. These hacks have menaced the industry, and up until a few weeks ago, there were reports of yet another hack. South Korean exchange Upbit reported an irregular withdrawal of about $51 million worth of Ethereum. Bitcoin not only threatened by exchange hacks. Although many of the top exchanges have good security, cybercriminals continue to work around the clock to get access to their networks. Like many others, there is a possibility that this secrecy is vulnerable and assets will be accessed. In some cases, like Quadriga CX, a Canadian exchange, it was a matter of lost keys. The alleged death, I say alleged because I don't think the guy's dead, alleged death of the exchange's CEO Gerald Cotton led to the loss of keys to the exchange's cold wallet, which didn't act like a cold wallet in any way, shape, or form. Reclaiming crypto sovereignty. The only way to be safe from these kinds of disasters is for traders to have their own private keys, especially those planning to hold for the long term. Withdrawing Bitcoin from exchanges and storing them on personal wallets ensures better security for the self and the entire industry. Additionally, it removes the incentive of a big payday for cybercriminals, reducing the number of bad actors as times they try to hack. As a bonus, it will support price stability over lower supply, pushing demand. Volatility on the market will fall and further support the success of crypto. Dude, fuck you. Crypto needs the volatility in order to succeed. I mean, really, what do you think differentiates it from other investment vehicles for people? But yeah, this is a danger that has always existed in crypto, and it saddens me that there are so many entities that are completely reticent concerning this. You know, I mean, I don't know that these guys are holding all of their Bitcoin in one wallet. They could be holding several wallets, and those addresses are attributable to them. And so they're counting in a cumulative the number of Bitcoin that they're holding, not necessarily in one wallet. I could be mistaken about that, but generally speaking, operational security-wise, it's a poor policy to keep more than, I would say, probably 100 Bitcoin in any one wallet. I think that's just dangerous. You know, I mean, considering loss, what if you lose the wallet for some reason? The device it's on craps out on you, or you just lose access to it. Somebody steals it. Now they got all 100 of your Bitcoin. However, if you were to put it on several wallets, and not necessarily store them in the same place, you've lowered the likelihood that any one event will completely wreck you. I mean, sure, it's more transactions, but again, it lowers the likelihood that a hit will completely wreck you. But yeah, so it's just a bad idea. Don't store a lot of crypto in any one place. And especially considering that there's always the potential there could be the run on an exchange, and they could have a liquidity crisis in the coin that you intend to cash out, be it Bitcoin or otherwise. Anyway, got this thing here. It's on crypto-markets.news. Binance adds Russian ruble trading pairs. And actually, there was a couple other articles I want to make sure that I get to now. Although that one's very important. Maybe that's a possible one right there. I'm trying to make sure that I'm covering all the ones that I really intended to cover today. No? Okay, yeah, that's appropriate there. In there, too. Alright. So yeah, Binance adds Russian ruble trading pairs. Where else can Binance expand to? And this is authored on December 2nd, 2019 at 9:20. No indication of AM or PM. Jonathan Gaynor. So yes, penis. Binance has made some major improvements and updates during the past year. Binance Coin launched their own chain. A launchpad was added for new cryptocurrency projects, and Binance has been expanding to more territories. This includes Binance's purchase of WazirX, an Indian peer-to-peer exchange, last week. The purchase was followed by the addition of the Indian rupee on the platform for various trading pairs. It appears that Binance didn't only have India in their mind when it came to expansion. Binance unrolls Russian ruble trading pairs. Much better. Besides India, another huge country where the US dollar is a bit uncommon is the Russian Federation. Binance has just unveiled that they will accept Russian ruble deposits and BNB/ruble, Bitcoin/ruble, Ethereum/ruble, and XRP/ruble trading pairs. Bullish. While Russia's population is only 146 million residents as compared to India's billion, Russia has a much higher purchasing power. This move will help consolidate Binance's position as possibly one of the largest global cryptocurrency exchanges. Seeing that Binance has added local currency support for many different local currencies, the biggest question is, where will Binance expand to next? One guess would probably be South America, where many residents have little faith in their national currencies. It could present a chance to bank the unbanked, which Bitcoin notoriously promised. Yeah. So there you have it. Binance getting international with their cryptocurrency. Imagine that. Before governments decided that they wanted to start regulating this at all, international participation on these cryptocurrency exchanges was the norm. Where we were seeing heightened activity during certain times of the day due to certain traders coming online from China or Russia or India or Korea. And so it's like, to me, that's basically where things are going to return to. Because we actually had relatively stable markets in that kind of space, where we had inflows of investors from all over the planet participating on the same marketplaces. To me, that demonstrates the real power of cryptocurrencies. And so, it weirds me out when I hear people talking about, new nations that they're expanding into and whatnot. I'm like, what's the big fucking deal? If I can communicate to somebody or with somebody, I can do commerce with them via cryptocurrencies. That's a simple reality here. And so having these permissioned portals, they're basically selling you back the freedom that you already had. And it's kind of sad, really. But I believe in the longer term, what we're going to find out is that it is more expensive to be these licensed portals than to simply use cryptocurrencies as money. And I think that in the longer term, we're probably going to see less speculative activity on the exchanges, and more of a response to actual global market penetration. If a cryptocurrency is traded on more exchanges, that it and more people are using it as money, the better the coin will perform. But it'll be an actual reflection of our use of it. It'll be something like Tesla cars. Where more people buy Teslas, the stock price for Tesla goes up because the popularity of the car is going up. And they're making more money, so they're worth more. There's a much lower likelihood that they're just going to die tomorrow. They got money flowing out the ass. And we're going to see where that kind of supporting cryptocurrency is more directly felt in the market. Like I said, I think that things like the stable coins and fiat currencies in general, they in themselves are tools that are used to distort the relative value of things in the marketplace. It's what keeps gas cheap enough for you to continue to buy it and fuel your vehicles with it. But again, in the longer term, these are finite resources. And so if we aren't replacing them with renewables, we're going to be kind of screwed in the future. Because the supply for these things, I personally believe that the supply for oil is finite. Maybe it expands, but it only expands at a finite rate. There's only so much planetary surface here for oil to be gathering in. And so if we've already hit it and it's not there anymore, it's not there anymore, period. Now, they've had instances where they've sucked an oil well dry, a conventional oil well dry, and they've tapped it like 20, 30 years later, and it somehow mysteriously gathers a pool of ooze in it, and they suck that dry for another couple years. And while that's cool, it may indicate that there is some sort of natural process going on, but again, I believe that drip down to those deposits is a kind of set rate event. It doesn't increase in rate just because we're sucking it out of the ground faster. So I think, with that being the case, there is going to be a point where we exceed the replenishing capability of the planet on these deposits. And I think that's kind of what fracking is when we've already exhausted the well by hitting it multiple times, and then going in there and sucking out all of the bacterial activity that's causing the petroleum distillates to accumulate in these deposits. We're so greedy to get those distillates out of there that we send down a chemical mixture with some water and basically evacuate the entire cavity of any distillates. Including the deposits that are impregnated in the walls. And I think that causes instability on the surface too. But that's just my thing. But like I said, I think over the longer term we're going to find that we've long exceeded the capability of the planet to replenish the oil, assuming, of course, that it isn't just a suck and done, which I think it is. That we're going to be having to transition to more renewable sources. And I think that we can do that. You know, there's a lot of doomsayers out there with regard to our ability to survive in the future. You know, given the limited nature of a lot of resources out there. But you know, if you look at the land use of the average American landowner, that is, it's relatively fallow. I mean, we're not really using a whole lot of it we use a lot of it, but not as much of it as we should to be husbanding animals, you know, raising livestock, growing crops. And that the fact of the matter is that there's plenty of possible production area for these things that we just have yet to facilitate. And that once we do, we're going to see that our needs are actually much less than our productive capabilities are. But it's going to require us all kind of getting boots on the ground with the participation, you know. Anyway, let's go ahead and throw back down into some music. And let's see here. What to play? I mean, because I've played a lot of good stuff so far, so, you know, it's kind of left me without a whole lot of options here. So here we go. A little bit of Static X for us. Cannibal. And that was Sixth with Bland Street Bloom. And so we are coming to the close, but I did manage to scrounge up one interesting little article. And, yeah, I think we should get into it. And so this one's on CoinDesk. Ex-CFTC Chair Giancarlo to push for digital dollar in new role at White Shoe Law Firm. This is authored on December 2nd, 2019 at 21:01. And this is authored by Nicholas D. So yes, penis. Former Commodity Futures Trading Commission CFTC Chairman J. Christopher Giancarlo is joining Wilkie Farr and Gallagher Law Firm as senior counsel, he announced on Monday. Giancarlo, known to most of the cryptocurrency world as Crypto Dad, will work on public policy positions, including advocating for the creation of a blockchain-based digital dollar, in addition to his work with the law firm's clients. Quote, after about 5 years in public service at the U.S. Commodities Futures Trading Commission, I want to continue to help build the digital financial markets of the future, Giancarlo said in an email. Quote, while assisting Wilkie clients in their worldwide commercial ventures, I will further focus on key issues of public policy through writing and personal service on both public and private boards. Giancarlo recently called for the creation of the digital dollar, with the former Lab CFTC head Daniel Gorfine warning that not doing so while other central banks experiment with blockchain technology and digital currencies could result in the greenback being replaced as a global standard. Actually, that's happening anyway. In his email Monday, Giancarlo said he plans to continue advocating for the digital dollar's development, as well as for an American replacement to the London Interbank Offered Rate, LIBOR. Quote, I expect soon to announce additional leadership roles in enterprises engaged in financial trading markets and digital commerce, he said. Since leaving the CFTC, Giancarlo has joined the Chamber of Digital Commerce as an advisor and the board of the American Financial Exchange, which sponsors Ameribor, a LIBOR alternative, and Ameribor futures. During his time with the agency, Giancarlo has called for a light-touch regulatory approach to the cryptocurrency space while testifying before Congress, earning praise from industry participants. Not from me. Under his tenure, the first Bitcoin futures and options products in the U.S. were approved from such companies as CME, CBOE, and LedgerX. Other firms have since announced their intentions to launch similar products, with the New York Stock Exchange's sister firm Bakkt launching its own physically settled Bitcoin futures in September 2019. Yeah. So, again, these guys that they're part of the legacy markets, but they don't seem to understand, they keep pushing for digital versions of the fiat currencies. And the problem with that is that you cannot force people to use it. As far as the dollar is concerned, it's already primarily digital. I think the number of outstanding dollars is like, 1 to 100 or something like that to the number that are supposedly circulating in digital form. And that's just on the Fed's books. But anyway, so, the idea of calling for a digital dollar, hey, give me a fucking break. You just got to modify your settlement process. The whole need for like a LIBOR or Ameribor or any other interbank agency setting the rate for the interest rate for settlement. Come on, give me a fucking break. You can refine that shit down to individual participants directly from the central bank itself. And so why we're looking to create another opaque body and an opaque body using cryptocurrencies is fucking ridiculous. But an opaque body that's going to be operating in between the banks and the greater global market at large, I think it's fucking silly. It's absolutely silly. It goes to show you that these people really don't understand this technology. There have been several chances for a national coin to work, and not a single one of them has. I think Navajo coin, I think that's Nav coin these days. I could be mistaken, but that's like the only one that's lasted for worth a shit. And again, I think that's only because they like rebranded and did some other shit in the background. And I could be mistaken about Navcoin being Navajo coin. Navajo coin was the only one that I remember, and from what I understand, it was NAV was their what do you call it? Their ticker. But anyway, like I said, we've seen these come and go. I think Greece was one of the first to try and do it. I think Spain tried to do it, and a few others. Greece, Spain, I think Portugal maybe? I can't remember. It seems to me that there have been multiple national cryptocurrencies, but because they're not directly associated with a central bank, the central bankers don't consider them valid. But the fact of the matter is that people haven't been using them. If you look to Venezuela with their petro, that thing is, from what I understand, it's never launched, or it's in really, really poor circulation and utilization. So, what does that tell you? The fact that it's backed by a national government means jack shinola. It doesn't matter. Again, we've all been leveled by Satoshi Nakamoto to just being potential users of coins. Which coin we're using, which coin we're storing our monetary value in, that's entirely up to us now. And I don't believe that any amount of regulation or laws is going to change that. If anything, I expect such measures taken against crypto or in attempts to try and wrangle the market in to being solely something that central bankers are in charge of, I think these attempts will fail. I think most attempts to regulate it will in fact fail. No matter how loud the IRS yells about how they're going to hammer down on crypto, I don't think it's going to happen. No matter how much they talk about making things illegal on exchanges and whatnot, I don't think it's going to happen. I think some people will listen to it and walk away, and I think others will double down. They'll see the dip and they'll say, buy the fucking dip, man. Because that's what they've done every other time there's been a lull in these markets, is just improve their positions. But that is the way of things, and I don't, like I said, I don't expect that to change about crypto. No matter how much a regulator may talk about doing that to cryptocurrency markets, they enjoy the volatility themselves. They enjoy the anonymity themselves. And so they are just as eager as you are to lose those attributes of their cryptocurrency holdings. It's a fact of life. And we can deny it. We can say we're not human and all that shit, but that shit isn't true, and you know it. Anyway, it is with that I'd like to bring this episode to a close. Unfortunately, I do not believe we will be having a Coin Metal on Wednesday. I gotta check my schedule, but if I'm gonna be here, I'll be here. Otherwise, I will be putting up a notice on either my Facebook or my yen.io account. And so, yeah, possibly Friday. We'll definitely be here Friday, but whether or not we're here Wednesday, that is still up in the air. I will do what I can to make sure that you guys know. And so as far as our last dance is concerned, I'm feeling the need. Cowboys from Hell, Pantera, Last Dance, here on Coin Metal. Thank you again for listening, and you all have an excellent day. Night. Yeah. Oh, wait. I almost forgot. Trade safe. Do your homework. And watch out for your own bunghole. And so, yeah, Cowboys from Hell, Last Dance, here on Coin Metal. Good night.